Good morning again, 111 students. So this is in continuation with your topic on merchandising type of business. So this is in relation to the four different freight terms I've mentioned in the previous video, whereby the buyer and the seller agree on this before shipping the goods from the seller to the buyer. So these four freight terms are, as agreed upon by the buyer and the seller, are FOB destination, freight prepaid, FOB destination, freight collect, FOB shipping point, freight prepaid, FOB shipping point, freight collect. So in FOB destination, it is the seller who is the owner of the goods, and the transfer of the title to the goods is passed on to the buyer upon destination. Whereas when we say FOB shipping point, so it is the buyer who is the owner of the goods from the moment the seller places the goods in the shipping area. So that means also that the transfer of the title to the goods has been passed on to the buyer the moment it is shipped. So who is responsible of the freight cost? So the responsibility of the freight cost is burdened by the owner of the goods. So meaning when it is FOB destination, it is the seller who is responsible for the freight cost because the owner is the seller. Whereas in FOB shipping point, the one that is responsible for the freight cost is the buyer, because in a shipping point, the buyer is the owner of the goods upon shipment. So therefore, in the FOB destination, that is freight prepaid, so it is the seller who is responsible for the freight cost. And also in FOB destination, freight collect, it is the seller who is responsible for the freight cost. So meaning it is the owner who is responsible for the freight cost. So in FOB destination, since the owner of the goods is still the seller, so therefore it is the seller who is responsible for the freight cost. In FOB shipping point, whether freight prepaid or freight collect, the responsibility of the freight cost is the buyer, because in an FOB shipping point, it is the buyer who is the owner of the goods upon shipment. But who actually pays the freight cost? So in freight prepaid, the freight cost has been paid for by the seller. In FOB destination, that is freight collect, the freight cost has been actually paid for by the buyer. In shipping point, freight prepaid, so since it is freight prepaid, meaning to say the seller paid the freight, and in a freight collect, the buyer pays the freight cost. So what is the accounting treatment if it is the, for example, if it is the seller who is responsible for the freight, but it is freight collect, so the buyer made the actual payment for the freight. So in here, we should discover these things in order to know the accounting treatment of how we are going to record the freight that is the responsibility of one and then paid for by the other party. Okay. So in FOB destination, freight prepaid. So since it is the seller who is the owner of the goods, so the seller records freight out, because that is actually cost of delivering products to the buyer. So the seller records freight out, and then syempre credit cash. In FOB destination freight collect, however, so because the owner is the seller, so the seller records freight out. But then, since it is the buyer who actually made the payment, so therefore the buyer will seek reimbursement from the seller, since it is the buyer who actually paid the shipping fee, which is, it should be the responsibility of the seller. So in actual scenario, actually, the reimbursement from the seller is actually deducted from the receivable or payable of the buyer to the seller. In FOB shipping point, freight prepaid. So since the owner is the buyer, so the buyer will record freight in. But it is not the buyer who made the freight paid because it was prepaid for by the seller. So therefore, the seller will seek reimbursement of the transportation paid because it should be the responsibility of the buyer to pay for the freight. So meaning to say, in here, the payable of the buyer to the seller will increase because of the transportation that is paid for by the seller, which is not the responsibility of the seller because the goods is shipped FOB shipping point. FOB shipping point freight collect. So in here, there's no problem because the owner is the buyer. And then, so the buyer will record freight in and then credit cash because it is the buyer who actually also paid the freight cost. So to illustrate, to have a better understanding of the concept laid down in the previous slide, so take this for example, this case 1 is FOB destination freight prepaid. So on March 15, 2020, ABC Company sold to Mr. Clean for 500,000 on credit with terms less 20%, 10%, to 10 and 30. The freight cost amounted to 12,000. So please take note here, ABC Company is the seller, Mr. Clean is the buyer. So to solve for the invoice price and the cash discount, so we have the invoice price is 500,000 times 0.80. 0.80 is actually 100 minus 20%. And then that was a series of trade discounts. So the next trade discount is 10%. So 100 minus 10% is 90%. So to compute for the invoice price, 500,000 times 0.80 times 0.90. So that is equal to 360,000. This is the amount that should be recorded as the value of the sales on the books of the seller and the value of the purchases on the books of the buyer. So compute for the cash discount if ever the amount is paid within the discount period. So 360,000 invoice price times the 2% cash discount. So the cash discount is 7,200 pesos. The entries on the seller's book and on the buyer's book. So on the seller's book on March 15, 2020, debit accounts receivable 360,000. Freight out 12,000. So the seller records freight out of 12,000 because this is FOB destination. And then since it is freight prepaid, so therefore the seller paid the freight. So credit cash 12,000. And then credit sales for the value of the sales, which is 360,000. On the books of the buyer, it should debit purchases 360,000 and credit accounts payable 360,000. So the buyer did not record freight in because it is FOB destination. So that means the owner of the goods is the seller because it will be transferred to the buyer upon destination. And since it is not yet arrived at the point of destination, so therefore the freight out is to be recorded by the seller and not by the buyer to record the freight in. So, and then also the buyer did not pay the cost of freight, so that's the only thing that it's recorded on the buyer's book: debit purchases and credit accounts payable. Assuming that the 360,000 has been settled on March 25, 2020, which is within the discount period, counting from 16, 17, 18, 19, 20, 21, 22, 23, 24, 25. So that's within 10 days. So the discount was 7,200. So 360,000 minus 7,200, the cash received by the seller is 352,800. Sales discount 7,200 is also debited and credit accounts receivable of 360,000. On the books of the buyer, to settle the liability, debit accounts payable 360,000. It made the cash payment of 352,800 because it availed of the purchase discount, which is 7,200, so credit also. Had it not been paid on March 25, so the entry on the seller's book is debit cash 360,000, credit accounts receivable 360,000. And on the buyer's book, settlement of the liability not availing of the discount will have a debit of accounts payable 360,000, credit cash 360,000. Another illustration. Second illustration is on FOB destination freight collect. So on March 15, 2020, ABC Company sold to Mr. Clean for 500,000 on credit with terms less 20, 10% to 10 and 30. The freight cost amounted to 12,000. The invoice price 500,000 times 0.80 times 0.90. So the explanation of this is similar to the first illustration, which is FOB destination freight prepaid. So the computation is the same. So 360,000 invoice price, the value to be recognized as the value of sales and the value of purchases. And the cash discount is 360,000 times 0.02, which is 7,200. So please remember that the first illustration is FOB destination freight prepaid. Well, in here, FOB destination freight collect. So meaning it was the buyer who actually made the freight cost payment, which is the responsibility of the seller. So the entries on the seller's book and the buyer's book. So on March 15, 2020, debit accounts receivable 360 340. Okay, let me calculate. So the seller's receivable should have been 360,000. However, the freight that should be the responsibility of the seller has been paid for by the buyer. So therefore, the buyer will seek reimbursement from the seller. So the seller will not pay cash but will deduct it from its receivable from the buyer. So that is why 360,000 minus 12,000. So 348,000. So accounts receivable 348,000, freight out 12,000, and credit sales 360,000. On the buyer's book, the value of the purchases is 360,000 as we computed on the previous slide. But its accounts payable is 348,000 payable to the seller because it pays the freight which is or which should have been the responsibility of the seller because the freight term is FOB destination. So that's why accounts payable is 348,000, credit cash for the freight which is 12,000. On March 25, upon settlement of the receivable or payable by the seller and the buyer. So the 300 the discount was previously computed in the previous slide at 7,200. That is actually based on the sales value. So 360,000 times 0.02, which is 7,200, and then deduct from the value of the accounts receivable, which is 348,000. So that's why the cash received by the seller is 340,800. And then the sales discount of 7,200, which is debited, and credit accounts receivable 348,000. On the books of the buyer, to settle the liability of accounts payable, which is 348,000, credits purchase discount because it made the payment on March 25, which is within the discount period. So 348,000 minus 7,200 of purchase discount, credit cash 340,800. So please take note that the discount is not to be computed based on the receivable or payable value. The discount is computed based on the value of the net sales or net purchases. So in this case, the sales and the purchases, which is 360,000. So if it has not been paid for on March 25, so the entry on the seller's book could have been debit cash 348,000 and credit accounts receivable 348,000. And also on the buyer's book, accounts payable 348,000 and credit cash 348,000 if it was paid or collected March 26 and so on. Another illustration or illustration 3 of case 3, which is FOB shipping point freight prepaid. So, on the same problem, on March 15, 2020, ABC company sold to Mr. Clean for 500,000 on credit with terms less 20, 10, 210, and 30. The freight cost amounted to 12,000. So the invoice price once again is computed at 500,000 times 0.80 times 0.90, so which is 360,000. And the cash discount is 360,000 times 0.02, which is 7,200. So the entries on the books of the seller and on the books of the buyer. So this is FOB shipping point freight prepaid. So the accounts receivable is 372,000 because the seller has paid for the freight, which should be the responsibility of the buyer. So that's why to seek reimbursement of the freight cost from the buyer, so the seller added up the value of the accounts receivable equal to the cost of the freight. So 360,000 plus 12,000, that is 372,000. And the sales is 360,000 and credit also cash 12,000 for the freight cost that is being paid for. So the seller here will not record freight out because this is not FOB destination. So since this is FOB shipping point, so the buyer will record freight in. So freight in 12,000. And the value of the purchases is 360,000. However, since it is not the buyer who made the freight cost payment of 12,000, so that is why its accounts payable to the seller will increase by the amount of the freight cost. So 360,000 plus the 12,000, that's 372,000. On March 25, 2020, to assume that the payable or receivable has been settled within the discount period, so the seller now will collect the receivable of 372,000 less the cash discount of 7,200. So total cash received by the seller is 364,800. That is computed as 372,000 minus 7,200. And then debit sales discount 7,200. Credit accounts receivable 372,000. On the books of the buyer will pay the accounts payable of 372,000, so eliminate the liability. And credit cash of 364,800 because it availed the purchase discount of 7,200. So credit purchase discount 7,200. If it made the settlement beyond March 25, so there is no discount involved. So the entry on the seller's book could have been debit cash 372,000 and credit accounts payable, accounts receivable 372,000. And on the buyer's book, accounts payable 372,000 and credit cash 372,000. The last but not the least of freight term is the FOB shipping point freight collect. So, on March 15, 2020, ABC Company sold to Mr. Clean for 500,000 on credit with terms less 20, 10%, 210, and 30. The freight cost amounted to 12,000. So, to compute again, the invoice price, 500,000 times 0.80 times 0.90. So, that's 360,000. And the cash discount is 360,000 times 0.02. So, 7,200. So the entries on the seller's book and the buyer's book. So since this is FOB shipping point, the seller will not record freight out. It is the buyer who will record freight in. So on the seller, debit accounts receivable 360,000 and credit sales 360,000. So it will not record cash because it did not pay for the freight, and it will not record also freight out because it is not FOB destination. Whereas the buyer, it will record purchases of 360,000, and since it is FOB shipping point, so it will be the one to record freight in, so 12,000. And then since it is freight collect, so therefore it was the buyer who made the payment of the freight, so credit cash 12,000, and then accounts payable 360,000. On March 25, 2020, assuming that the liability or the receivable is settled within the discount period, so the seller will collect 360,000 minus 7,200 of cash discount. So debit cash 352,800, debit sales discount 7,200, and credit accounts receivable 360,000. On the buyer's book, so settle the liability. So debit accounts payable 360,000, pay the cash less discount, so 352,800, and credit purchase discount 7,200. Had it been paid or collected beyond March 25, so the entry on the seller's book could have been debit cash 360,000 and credit accounts receivable 360,000. And on the buyer's book, it could have been accounts payable 360,000 and credit cash 360,000. How to record the payroll? So on August 31, 2020, the company paid the salaries of employees for the second half of the month as follows. So this is prepared for as the gross pay of the salaries of the employees is 100,000, and then there are statutory deductions which are the employees' share of its SSS premiums, PhilHealth, Pag-ibig, and also for the tax on income of the employee. So let us say, SSS premium is 4,000, PhilHealth 2,000, Pag-ibig 3,000, and withholding taxes 1,000. And then there's an employee advances of 500. So the total deductions to be made to the salaries of the employees amounted to 10,500. So 100,000 minus 10,500, the net amount paid to employees is 89,500 total. So to prepare the entry for this, debit salaries expense 100,000, which is the gross pay, and then credit SSS premiums payable because this is payable to the SSS office, and then PhilHealth premiums payable, this is to be remitted to the PhilHealth office. Pag-ibig premiums payable, and this one is to be remitted to the Pag-ibig office. Then withholding taxes payable 1,000, this is to be remitted to the BIR office. Advances of employees 500, and then credit cash 89,500. So advances of employees actually takes the form of the employees made a cash advance from the employer. So it shall be collected also by the employer from the employee's salary. Next is there's also employer's share when it comes to these mandatory contributions. So, for example, if the employer's share for the SSS of its employee amounted to 6,000, the PhilHealth for its employee as an employer's share is 2,000, Pag-ibig 3,000. So, the entry will be debit SSS contribution expense 6,000. So, this is an expense on the part of the business because this is not deducted from the gross salary of the employees, but from the business itself. Next, PhilHealth contribution expense, 3,000. Actually, that's 2,000. And then, Pag-ibig contribution expense, 3,000. So, nag-interchange lang yung amount po. So, sorry for that. Then, SSS premiums payable, 6,000. PhilHealth premiums payable, 3,000. Pag-ibig premiums payable, 2,000. So, this sum payable shall be remitted to the different offices. So, SSS premiums payable, you just have to add the employee share and the employer's share, so which was 6,000 plus 4,000, so 10,000. PhilHealth premiums payable, 3,000 plus 2,000, so 5,000. Pag-ibig premiums payable, so 3 plus 2,000, 5,000. Withholding taxes payable, 1,000. And credit cash, 21,000. So the periodic inventory system and the perpetual inventory system, which I mentioned in the previous video, is to be discussed here. So the periodic inventory system is commonly used for businesses with fast moving items, which are also small in value and with so much variation, such as grocery items. Perpetual inventory system, on the other hand, is being used for businesses with high-priced items of inventory such as cars and jewelry. Seller's point of view, periodic inventory system versus perpetual inventory system. Okay, so this is not actually just the seller's point of view, because in merchandising, the business can be the buyer and can also be the seller. So let us remove here the seller's point of view, because it can be the buyer and the seller. So depending upon the given information. So number one, to record purchase of merchandise worth 100,000 to 10 and 45. So, debit purchases, 100,000. Inventory, 100,000 for perpetual inventory system. Then, credit accounts payable. So, please take note, under the periodic inventory system, it makes use of the account title purchases. Whereas, perpetual inventory system, every time there is a purchase, the account title debited is inventory. To record payment of freight. So, for periodic inventory system, it will record freight in, credit, cash. Whereas, under the perpetual inventory system, every time there is a freight by the buyer, because we are the buyer here since we purchased the merchandise. So, inventory, 3,000 and credit, cash, 3,000. To record return of merchandise worth 10,000. So, since we returned, so debit accounts payable 10,000. And then, for periodic system, purchase returns and allowance, 10,000. But under the perpetual inventory system, there is no account title that is purchase returns and allowance. So, it immediately credits inventory. So, that means under the perpetual inventory system, every time there is a merchandise that comes in, debit inventory. If there is outgoing, so credit inventory. Next is, after purchasing somehow items, of course we will sell, because that is the nature of our business, merchandising type. So, to record before we sell, so let's say we made the payment first. So, our accounts payable was 100,000 less 10,000 because we returned 10,000, so 90,000. So, credit cash, 88,200 because we deducted discount of 90,000 times 0.02. So, that's why 1,800. So, purchase discount is 1,800. Therefore, the cash paid is 88,200. So, under the perpetual inventory system, we do not use the account title purchase discount. Instead, directly deduct it from inventory. So, meaning to say, such as the freight in, which is an adjunct to the purchases, sa perpetual inventory system, it is directly added to the inventory. And in here, purchase discount, which is a contra account of purchases. So, in here, we don't have a contra account, but it is immediately or directly deducted from the inventory, the purchase discount. So, that's why you can see the difference. The purchase discount under the periodic inventory system, the credit is inventory under the perpetual inventory system. So, if this is beyond discount period, so debit accounts payable, 90,000 and credit cash, 90,000. So, number 5, periodic inventory system versus perpetual inventory system. So, to record sales and account merchandise costing 50,000 at 75,000 to 10 and 30. So, debit accounts receivable, 75,000. Credit sales, 75,000. So, this is actually at selling price. But then, under the perpetual inventory system, it has 2 entries. So, it shall make an additional entry of debiting cost of sales 50,000 and credit inventory 50,000. So that you can see that under the perpetual inventory system, at any time you will have an account balance of the inventory value. Number 6, to record freight to deliver the goods to customer, 1,000. So, debit freight out, 1,000, credit, cash. This is same entry under the perpetual inventory system. To record merchandise at selling price of 7,500 with cost of 5,000 that is returned by the customer. So, to receive the return, so debit sales returns and allowances, 7,500. Credit accounts receivable, 7,500. So, take note, under the periodic and perpetual inventory system, both are the same entry. But then, under the perpetual inventory system, it will detail the incoming, or shall I say, the receipt of the inventory that has been returned. So debit inventory 5,000 and credit cost of sales 5,000. So that every now and then the value of its inventory is actually updated and detailed. And also the cost of sales is detailed and updated. Periodic inventory system, another transaction to record collection of customers' account within the discount period. So, our accounts receivable is 67,500 because we deducted the 7,500 from our sales. So, sales minus 7,500 of return. So, the net accounts receivable is 67,500. And then, times 0.02. So, we get the sales discount at 1,350. So please take note that under both methods, collection of accounts is the same entry. At the end of the accounting period, let's say it revealed that the physical count of inventory at cost amounted to 46,000 at the end of the accounting period. So the entry under the periodic system is debit inventory 46,800 and credit income summary 46,800. So this is the explanation of this is to set up the ending inventory. Whereas for the perpetual system, so it will compute the balance of the inventory. So this is actually the account inventory ledger. So debits are 100,000, 3,000, 5,000, and the credits 10,000, 1,800, and 50,000. Please take note this debits and credits come from our entries. So total debits 108,000, total credits 61,800. So the balance, the debit balance of our inventory is 46,200. So therefore, if the physical count is equal to the ledger balance of the inventory account, under the perpetual inventory system, there will be no entry if the ledger balance is equal to the physical inventory count. However, if the physical count is lesser amount than the physical, oh my gosh, if the physical count is lesser amount than the ledger balance, sorry, so kindly just correct that, the ledger balance. So physical count is less than the ledger balance, so the entry will be debit cost of sales and credit inventory. If the shortage is normal, so normal shortage or normal, it's just it within the normal range, so it is buried to cost of sales. So let us deduct it from inventory because the physical count is less than the ledger balance. However, if the amount of shortage is bigger amount, so it is not or no longer within the normal range, so we will debit loss on inventory shortage and credit inventory. So debit cost of sales, credit inventory if it normal range. Debit loss on inventory shortage and credit inventory if that is abnormal. So, by the way, if there is no made mention of normal or abnormal, just assume that that is normal. The end. So, thank you, and on the next video, we will discuss about the preparation of the income statement of the merchandising type concern of business, computing gross profit, net income, and the preparation actually of the income statement of a merchandising type concern of business. Thank you and God bless everyone.